Welcome back to the deep dive. Today we are looking at a really remarkable and frankly quite rare alignment of market signals.
It really is. For months, it felt like investors were just navigating through these choppy, confusing waters.
Totally. Trying to figure out, are we heading for a hard landing, a soft landing, or are we just stuck in this permanent state of uncertainty?
Mhm.
But then over the past week, a very strong set of data points just snapped into place. We saw it from tech, from the consumer, from the macro data.
And they completely reset the mood.
It did. The entire mood shifted toward a confident, risk-on mode. So our mission today is to unpack exactly how these three forces are aligned. You have this massive validated AI investment boost.
Right.
You have incredibly resilient consumer spending that's focused on value, and then steady, supportive labor data. And the central multi-trillion-dollar question is, how long can this perfect alignment possibly last?
And this is all happening after a long stretch where, the foundational fear was legitimate.
Oh, absolutely.
Everyone saw the staggering capital expenditure going into AI infrastructure, the chips, the power, all of it. But the worry was that this capex had sprinted way too far ahead of any measurable returns. Was it a bubble?
Was it just hype? Yeah.
Exactly. And with high interest rates and real valuation concerns, it was a valid question. But this recent set of events, starting with NVIDIA's colossal outlook that confirmed by Walmart and solidified by the jobs report, it just provided the shock absorber the market needed.
And what did that show, fundamentally?
It showed that corporate balance sheets, especially in tech, in that kind of defensive retail space, are just far stronger, and the growth pipeline is much clearer than the pessimists feared.
And we saw the market reaction immediately. It was unmistakable. A clear rotation into growth. The S&P 500 jumped over 1.2%.
Nasdaq over 1%. But that's not even the most telling part.
Right. The key tell for you, the listener, is what happened with the safe haven assets. We saw softness in gold prices. The dollar stayed steady.
And that's the classic sign, isn't it? Investors are actively moving capital into growth assets, not de-risking into safety.
It's the cleanest signal you can get. The fear trade is off. The growth trade is back on.
And there's no doubt what the primary engine is. It's AI. Specifically, it's the confirmation of that long-term spending trajectory.
Okay, let's unpack that AI engine then. Because a single company's earnings report, it rarely settles such a massive macroeconomic debate, but that is precisely what NVIDIA just did. So how big was this blowout?
The numbers were just spectacular enough to settle it instantly. So they reported $57 billion in revenue, which led to a 67% earnings beat.
Wow.
But honestly, those raw figures are less important than the forecast. They guided revenue for the current quarter toward an astronomical $65 billion.
Which was way above what even the most optimistic analysts were thinking, right?
Significantly. And the market responded, of course.
Yeah.
Stock rose, pulling the whole tech index with it. But what's fascinating is the psychology here. The stock reaction, it was positive, but it wasn't some crazy triple-digit spike. It felt measured.
Right.
A sort of calm confirmation.
Exactly. That muted yet positive 4% rise suggests investors are now treating this as confirmation of a structural reality, not a shocking surprise. The narrative shifted from, is AI real? To, okay, AI is real, and the build-out is accelerating even faster than we thought.
So what was the key signal from management that gave investors that confidence?
Well, crucially, they didn't just stress strong current demand. They stressed that compute demand across data centers, AI agents, and infrastructure is still accelerating. And if you look past the headlines into the operational details, this is the real insight.
The inventory build.
The inventory build and their raw material commitments. They are actively planning for several more quarters of this kind of demand. This isn't just about burning through a backlog. They're validating a long, deep structural expansion. That's a sustained capital cycle.
So the story is now spreading beyond just to chip makers, because once that capex is validated, the rest of corporate America, especially the hyperscalers, they have to shift their strategy to justify that spend. They have to. And we're seeing it. Look at Microsoft. CEO Satya Nadella has enlisted Rolf Harms, who was one of the original architects of their Azure cloud strategy,
A brilliant move.
to fundamentally rethink the economics of AI across their entire platform.
It feels like history repeating itself. Azure had to do this in its early days, right? Restructure internally to make sense of the massive upfront investment in cloud.
They absolutely are doing the same thing for AI. The old Azure model, where you sold compute as a cheap, time-based utility, it just doesn't work for AI.
Why not?
Because training large language models or running constant high-speed inference is just disproportionately expensive.
Yeah.
It needs huge processing clusters, massive energy draw. This strategy shift signals that AI isn't just an add-on,
It's a new core business model.
requires a new core business model. Microsoft needs higher margins, new pricing, new ways to amortize that cost. Getting the unit economics right is the key to unlocking the real returns on that NVIDIA CapEx.
And while Microsoft is working on the infrastructure, Google is sprinting on the product side. They just unveiled Nano Banana Pro.
Built on Gemini 3 Pro. And this is clearly a move beyond just consumer fun. This is about monetizable, heavy-duty business content creation.
So what can it do?
It's all about getting into these deep, expensive productivity workflows. For instance, it could take a huge spreadsheet of code or hundreds of CVs and turn them into interactive infographics instantly. It's moving into visual editing that used to require expensive design teams.
And they're tying those tools directly to their cloud platforms like Workspace and Google Cloud.
That's the monetization play. And we know these things get adopted at breakneck speed.
Right. The earlier version added, 13 million users in 4 days?
Exactly. The speed at which core business functions are being redefined by AI is, well, it's arguably the most bullish indicator in the market right now.
Okay, so if AI is the future-facing investment, let's talk about the present. What does the American consumer look like? This is where Walmart's surprisingly strong results come in as a key counterpoint to all the uncertainty.
Walmart's performance was the perfect illustration of what resilient means in this economy. They raised their full-year guidance. They reported strong, mid-single-digit top-line growth.
And their e-commerce was huge.
Over 20% expansion. And this tells us the consumer's definitely still spending, but they're prioritizing value and convenience above everything else.
So it's not just that their base is loyal, they're actually taking customers from competitors.
That's what they credited. Continuous share gains.
So what are the specific insights we can pull from their books? It's not just about strong sales.
Two things really stand out. First, internally, they are maximizing profitability from higher margin services. They're converting all that traffic into revenue through advertising and memberships, specifically their retail media network, Walmart Connect.
That's the profit engine.
That's the profit engine. It generates margins their core grocery business just can't touch. And second, their customer base is changing. Walmart is now pulling customers from a much wider range of income brackets. Affluent shoppers, feeling the pinch from inflation, are trading down for staples and using the convenience factor.
So this isn't just a story about low-income stability.
No, it's a story about the middle and upper middle classes prioritizing value over brand loyalty.
And you can see the inverse of this when you look at some of their competitors. Weaker performance from, say, Target shows that it's not just about the category you're in.
No, it's about execution, it's about inventory management, price architecture. It's a highly unforgiving consumer environment right now. The structural implication is that mid-tier specialty retail is just getting hollowed out. Consumers are slocking to either high-end luxury or extreme value.
Leaving that middle ground very vulnerable.
And Walmart's success is a perfect reflection of that shift.
Okay, which brings us to the third leg of this tripod, the macro backdrop. The latest jobs report helps explain how the market can feel so risk-on, even with tight monetary policy.
This was a critical report. And the results really confirmed the market's cooling without cracking thesis. U.S. non-farm payrolls rose by 119,000 in September.
Which was way above expectations, right? They were sitting around 50,000.
Yeah, strong headline number. But the internal dynamics are what prevent overheating. The unemployment rate actually picked up to 4.4%, the highest since 2021.
And wage growth was moderate.
Just 0.2% month on month. So the mix is what's key.
This is the magic trick, isn't it? Solid employment numbers that signal corporate health, but just cool enough to keep the inflation hawks from raising the alarm. So what does this mean for the Fed?
It strengthens the case for them to just stay put. It suggests companies are reluctant to do mass layoffs, which prevents a sharp recession. But they're also being extremely cautious on new hiring and wage increases, which keeps inflation contained.
And we know from the October meeting minutes that most officials want to keep rates on hold for the rest of 2025.
This report fits that wait-and-see narrative perfectly. It gives them cover to do exactly that.
So the market is currently buying this whole idea that massive AI investment, solid employment, and contained inflation can all coexist. It's an incredibly bullish alignment.
An alignment few would have predicted 6 months ago.
But let's challenge this for a second. You mentioned the restrictive rates are staying put. Doesn't the Fed's reluctance to cut Mean they're essentially betting that the strength of the AI sector and, a few retailers like Walmart.
Are strong enough to carry the weight of the entire rest of the economy.
Exactly. The cyclicals, small businesses, the parts of the economy that are still really struggling under high rates.
That is precisely the core tension. This isn't unified growth, it's a growth bifurcation. The Fed is betting that the productivity gains and the wealth effect from tech will offset the drag that small businesses and manufacturing are feeling from tight credit,
So we're asking one or two dominant sectors to pull the entire economy forward.
while maintaining rates that are deliberately slowing the other half. It's a tightrope walk.
Mm-hmm.
Any misstep in the AI capex cycle or a sudden pullback in consumer confidence could break the entire alignment.
So wrapping this all up, what does it mean for the next few quarters? We have the validation. NVIDIA on AI capex, Walmart on the consumer, and the jobs report providing a supportive backdrop. What are the key points of tension that will test this new risk-on mentality?
We're watching three specific areas very closely. Number one, does this rally broaden out? Does the momentum move beyond the mega cap AI names into cyclicals, small caps, the industrial complex?
If it doesn't, it's still a very narrow, fragile recovery.
Exactly. Number two, the bond market. How do 10-year Treasury yields react to this stronger data and the cautious Fed? If long rates start spiking, they'll act as a major cap on equity upside.
And finally,
The ultimate validation point. We need signals on the pace and payback of AI infrastructure spending from the big cloud customers. We know Microsoft and Alphabet are re-engineering, but the market needs concrete guidance on when that capex starts flowing back into revenue and margin expansion beyond the chip makers.
that structural payback really is the ultimate decider. So, since we've established that value and convenience are trumping brand loyalty and that AI requires this massive infrastructural and economic restructuring, the final question for you is this. How quickly will the returns from this enormous tech investment trickle down to validate valuations across the broader economy? Or will the rewards just remain concentrated in a handful of names, causing that economic bifurcation to widen even further? That's something to mull over. That's your deep dive for today. We'll see you next time.